So thank you, Nicole and Coyote, for putting this together. And very happy to be back here. My name is Faraji Whalen Robinson. I'm a 2009 graduate of the CRE, and I'm the founder of a startup called Southbanc. We're an advisory and investment firm based out of Washington, D.C., and our focus is in putting minority capital into minority developers and entrepreneurs' hands. Started this about a year ago, really when the opportunity zones legislation kind of started bubbling up, and we thought that was going to be a particular thing. And now it's a little bit of a different thing, but we're still, kind of really focused on transforming neighborhoods, kind of via the people that are at the table in real estate investment, development, and brokerage. So over the past 10 years, I've worked for some small development firms, done asset management, I've done a lot of brokerage, retail, and office, and kind of that's all come together to bring me here. So from a social impact side, I think what we're doing is really about the people on the ground in kind of neighborhoods throughout this country who have not necessarily been at the table before, who have not necessarily been the winners in kind of a win-lose economic frame. So.
Thank you, Faraji. Alan?
My name is Alan Sage. I'm here representing the Goldman Sachs Urban Investment Group. So the Urban Investment Group, or UIG, is a multi-asset class investing platform that invests Goldman Sachs' balance sheet capital to positively impact communities. So we've really taken, if I had to sum it up in one sentence, a place-based approach to investing. So we've invested over $7 billion to date. We've done so typically by targeting a neighborhood where we feel there is a specific need, be it for affordable housing, be it for community facility space, or for educational facilities, and really taking a holistic approach to providing capital to those communities. For example, we've invested a significant amount in Newark, New Jersey, where we finance a number of charter schools. We finance a number of affordable housing and mixed use and mixed income facilities. And basically we feel that often by deploying our capital in a thoughtful way based on what a specific community needs and based on what the public sector's goals are, we can generate the most positive impact with our capital.
Very interesting. Dan?
Thank you, Allison. Thank you for having me. I'm here on behalf of Enterprise Community Partners. We are a nationwide nonprofit affordable housing investment firm. We have $12 billion under asset management. And what we have a three-legged stool: capital, solutions, and policy. I work on the capital side. We have 6 capital products. The primary one is the low-income housing tax credit syndication business, where we originate over $1 billion a year in low-income housing tax credit equity. Enterprise's mission is to drive opportunity for low and middle-income communities through housing. We have a number of different initiatives, including green initiatives, health for housing to address the social determinants of health, and that sort of thing. We've got a number of other opportunity zones that we're working in, loan funds, a variety of different opportunities on the capital side, as well as a number of solutions. We work closely with the local governments and municipalities around the country to help develop, say, green housing initiatives and develop a framework around how do we drive community resiliency in the built environment.
We talked a little bit about this beforehand, about kind of the social impact returns versus financial returns and what's more important. At the end of the day, if you meet your financial returns, you live to fight another day. It's kind of the unfortunate reality that a lot of what we go into kind of deals looking at and thinking about from a social impact side either does or doesn't happen on a long enough timeline, and there's a little less control there. But from an economic standpoint, if I deliver my LPs the returns that I promise them, I can always do another deal. If I don't deliver the social impact, they're not feeling the pain, unfortunately. And so what we're trying to figure out is how do we get people who are feeling the pain, who really care about people who are feeling the pain, into that capital stack, because those are the people that are really going to drive. And I don't necessarily think it's going to be purely institutional money. I don't think it's going to be just the same people who've been at the table in real estate. And one of the reasons we kind of started the company around the same time the opportunity zones came in was because we really saw the opportunity here not in, kind of the same people getting a new tax break. We thought we would have a flood of new people, who came into the space and who were really about that. And we've seen some of that, and we've had some, kind of really encouraging conversations around people whose primary goal is listen. I don't really care about a couple of bips here and there. I really want to see something different happen in our neighborhood. So,
I mean, I think part of the question too is who should be making the determination about what are the appropriate ESG or social impact goals. And I think the approach we've often taken is trying to be as agnostic as possible and really relying on the public sector, which is really, in our view, best suited to be making those decisions, to guide our investment decisions from an impact standpoint. And what that means practically is, we don't just put capital out in neighborhoods where we think there is a potential to, generate a positive impact. We're really being reactive to the public sector. I think a good example of that is, one of our investments in Jamaica, Queens. Jamaica was the largest single rezoning under Mayor Bloomberg's administration, and then under Mayor de Blasio, it really became a focus for mixed income housing. So we invested in one of the first large new mixed income developments, which really set the agenda for that neighborhood, to become a sustainable mixed income community and not just be overrun with market rate development. And the public sector was really there to support it. They put the capital behind it. They put the policy in place. And so it made sense, and we were able to generate a strong financial return while also at the same time supporting the public sector's impact goals.
Yeah, so there's a couple different ways to approach it, or to approach this question. One is enterprise has a number of capital products that I've sort of touched on a little bit. We've created different funds with different themes and different opportunities, whether it's in the low income, the middle income, or the workforce housing, different vehicles. The other thing we've done successfully is we're working with our existing or new investors to create thematic funds. Some have a preference for, say, Native American or tribal housing. That's a really interesting thematic fund that we've got with an investor that prefers to drive capital into those underserved and vulnerable communities. Another one that we've done, which is interesting for a whole host of reasons, is a Health for Housing Fund with Kaiser Permanente. They have seeded a fund to acquire workforce housing that's not low-income restricted, low-income tax credit restricted. What they'll do is they'll provide low-cost capital. They'll acquire these buildings in Oakland and Oakland of the Bay Area, which is where KP has a big presence. Upon entry or leasing a unit there, you fill out these surveys, personal surveys regarding your current health status, your health goals, and how KP can provide support against reaching those goals. So there's an individual survey, and you measure those results year after year. And KP handles that outside of our jurisdiction. We don't get those certain figures. We don't get those numbers. We don't, frankly, want them, the medical stuff. The other thing that we've done is created these community-based health action plans. So what are the barriers to health in Oakland for this community on this block? Is it transit? Is it air quality? Is it access to healthcare? Is it too far? Is it off the bus line? How can we address those needs of this community and this block and this address? And so we'll develop action plans with community stakeholders, Kaiser Permanente, other organizations in the area that have mission-aligned objectives, and we'll pull those resources together. And so those are the sorts of things that we've got access to a lot of different tools where we can sort of quarterback a lot of opportunities, and we'll respond to the investors' needs or desires. And sometimes they just say, provide the top financial return, and we can do that too. But the really interesting stuff happens on the other side of that.
Mm-hmm.
And I think this goes back to my earlier point too, that we're really sort of focused early on understanding what the public sector's goals are for a certain city or for a certain neighborhood. I think the best example I would probably choose is we were the investor in Teachers Village, which for those who aren't familiar, it's a mixed-use development in downtown Newark, New Jersey, which included new schools, new affordable housing for teachers, and a significant amount of retail space in a previously underutilized corridor. So we sort of came on early when the developer was looking at the site and having initial discussions with the city. We were very engaged in those discussions and understanding what the public sector's goals were for the neighborhood, what they felt like was the need. And I think one of the counterintuitive, indications we got from the public sector is that they were really focused on having high quality market rate housing. And I think we felt it was also important at the same time that even though when Teachers Village came online, there had not been new market rate housing built in Newark in a number of decades. But we felt it was also important to think forward and think that, okay, right now the issue is focusing on quality market rate housing, but we also need to include a portion that's affordable given if the neighborhood, if rents increase, what is the conversation going to be like a few years from now? So I think that's probably sort of the best example of coming on early, and then our development partner on that transaction was in discussions with a number of different public agencies, a number of different nonprofit organizations, and so we really were able to sort of work with them and better understand what the different goals were for the development.
So we're a startup, so we're still kind of putting together, Southbanc's first projects. I can talk a little bit about some things which I think are going to be really exciting here. But I can talk a little bit about, kind of my group. I used to work for the Mankiti group back in DC. That's where I really kind of cut my teeth in kind of urban investing and kind of street retail and street commercial. And what I found really moved the needle at the end of the day is where we were making a change wasn't just in the kind of real estate that we were putting together. It was the people that we were supporting in that real estate, especially the business people and the entrepreneurs, right? So, when you have a neighborhood, especially, kind of denser urban neighborhoods, that first like 18 feet is really kind of where things happen, right? What you see on the street, if you're in the bus stop, kind of the corner store, the retail going down the end lines, and who's in there. So we were really able to, kind of help a lot of local entrepreneurs who really kind of weren't quite ready to be tenants, frankly, right? They need a lot of massaging and a lot of work, and, kind of lead some to places like Wakeif or, kind of other kind of community and economic development folks. And we would really kind of do outreach to help people who wanted to take that next step, right? Build your first business, or, you have kind of a struggling first business, let's stabilize you, let's get you to the second, kind of location so that you can start off and end up being a franchise. Like, I think that's where we really kind of push the needle in a sustainable way, because if you make somebody a better business person, that goes regardless of what happens with the real estate, or if we sell it, kind of after the cycle is out. Right now we're working on a couple of what I think are really interesting deals, and a bunch of them have ended up being kind of arts focused, right?
Okay.
And so this isn't what I expected us to end up, but we're working with Prism Art. I just came back from Miami to this beautiful paradise of Boston. We're working with Prism Art Fair, who it's a small minority female-owned art fair. They've worked around Art Basel for the past 5, 6, 7 years. Been very successful, and now they're looking for a full-time space. And what that's going to allow them to do is not just be kind of in a one-time kind of deal, but throughout the year, they're going to be able to provide gallery space for artists, so that's going to help artists sell more art. They're going to be able to provide training space to provide kind of more access for minorities to get into the museum space, which is just historically the huge representation issues. And kind of also doing some training components and helping artists become better business people themselves. So these are the kind of deals, and these are smaller deals, 5 to 20 million bucks. But I think if we put together enough of those deals in enough of the right places, we can really kind of make a huge difference. Doing a similar project in DC also, an arts-based program, a building that, is fallen to pieces. The sponsor passed and didn't really leave her affairs in good order. And we are programming what's going to look like maybe 25,000 square feet of public event space, art space, housing. Knock on wood, it could be some artist housing. I don't know if we're going to be able to slide that through. But I think these are, from our thesis, is that that's what matters, is the people who use our real estate.
Sure. So as an example, that Health for Housing Fund with Kaiser Permanente, like I said, they measure, and they've got a number on the or a series of questions on the survey. You can measure each year's progress towards the goals, and then upon exit or exiting of the community, you'll have identified where you stand against those goals. And initial reports are that it's performing very well. Like any first try at anything, we're learning a lot along the way of some things that don't work, some things that do work, little trips and hazards along the way. Identifying and creating durable and resilient metrics that can be applied at scale is one of the biggest challenges. And so everybody in the room might have a different way of measuring the same thing from start to finish, and where's the start and when is the finish, and all those different things. And so reporting that upstream to the investors or to the public realm becomes very complicated in this area of privacy that we're now dealing with across all sorts of the spectrum. But one of the, it's a little blunt to say you know it when you see it, but I can think back into a time prior to my work at Enterprise where in Jacksonville, Florida, there's a homeless community that had a shelter for men and then a shelter for women and families on the same site in different buildings. The facility was bursting at the seams. They got together with the hospitals and they allocated funding. They got a light tech allocation of low-income housing tax credits to build an off-site women's and children's and families facility, half of which was low-income affordable housing. The other half was respite units from the local hospitals. Having people linger in hospital beds is very expensive for hospitals. It's some absurd number, so it's cheaper for them to fund the construction of this off-site respite care and then also offer a subsidy to help operate. They'll put nurses, dentists, all the different sort of low friction medical care in the ground floor. The other half, like I said, is the affordable housing, more permanent supportive housing for these women and families. That would be, you can measure that lots of different ways. And maybe it's not needed to actually put it on paper and report it upstream, but you know that 70 units of permanent supportive housing was now developed for these vulnerable population of women and families that are now housed in beautiful, shiny new building. And the respite units are well cared for. People are exiting these hospital beds. They're not getting returned back to the streets. They're going into care, able to access these different things that they never had access to before. And so that's not something that was designed. We didn't design a measurement tool. It would be very simple to do so. But our investors at the time didn't require it. They were very happy to know that it was being done. One of the things that investors do like, particularly around the Native American and tribal housing, like I mentioned before, was the ability to be on site, attend the ribbon cutting, get a lot of branding and PR and marketing opportunities out of that. So they'll accept more or less a lower cost return in exchange for that sort of branding opportunity. And the last thing I'll say is, at another organization I know, they're happy with earning a lower return so long as their principal's not at risk. And so they'll say, we'll accept something in the 1, 2, 3% range so long as we have not necessarily a guarantee per se, but very measured, layered senior position in this fund or this investment. So a lot of people will say, go do really great things, just return us a couple percent and we'll be happy. And that can be accomplished a lot of different ways, but I'll stop talking.
Sort of just also to build off the reporting question and how you sort of track impacts. I think in real estate we've gotten very good at tracking primary impacts, which is not that hard. You say we built X number of affordable housing units and housed X number of families. It's not rocket science. Obviously, the harder thing is tracking the secondary impacts and saying, if we created this impact, but we built a new workforce training center. How many jobs did this create? Or we created a new affordable housing unit that supported a family. How did that impact them? In their pursuits. I think part of it is a reporting thing, but part of it is also just making sure that our capital is not sort of purely confined to real estate. I think we've a lot of the community development finance work that goes on in the U.S. is really focused on the built environment, and our group has been very focused on making sure that when we see a need that is complemented by our real estate work, that we are also providing other sources of flexible capital to complement it. So for example, we recently closed on a facility that was basically to provide students with access to vocational training, basically looking at data of how different vocational training programs would improve people's credit scores and ability to repay these loans after they've completed them, as opposed to traditionally a lot of people are unable to access credit to pursue these kind of programs because it's based on their current credit score. So we felt that was a complement to a lot of our built environment work focused on workforce development, but it really was a gap that needed something that went a little bit beyond the built environment to really complement it.
The best bet I see in real estate investment right now is really investing in, I'm going to keep harping on people,
Okay.
but is investing in small and local businesses. I know San Francisco and New York loves kind of these high growth tech plays, but at the end of the day, the small 1 to 2 person shop that can grow into a 5 person, that can grow into a 10 person shop, you invest in, kind of real estate and or those ventures at scale, you will do very well for yourself.
I would say one of the biggest opportunities we see is really sort of future-proofing housing as affordable. It's expensive to create very low-income housing. We do a lot of that work, but there's just a finite number of public capital that's available for it. So we see a lot of opportunities in projects where a public sector agency might restrict rents at a project at a level that right now is above market, but that in the future could certainly be affordable. And a lot of times, developers are not going to push back on that as strongly just because, they're not sort of thinking about, what might happen in the long term. And it can often, in the end, if a market really changes, it can be sort of a saving grace in terms of preserving housing as affordable at a range of income tiers.
In the affordable housing space, particularly in the deeply low-income space, for me, it should be more than building 4 walls at an affordable price. We should address sort of in user design experience speak, the journey between a resident's journey, right? So is their stressors, how can we address that? Is it childcare between the hours of 3 and 6 when they return home? Okay, let's put an on-site childcare facility and we'll subsidize it with partners. We'll put a library in there. We'll have some books. I've seen places where they decommission a low-income unit, and that's now the after-school care facility. Okay, what else can we do? Can we bring a dental truck? Those mobile medical trucks and vans where they come on site, they'll draw blood. Do, like I said, those low-friction, easy to do healthcare activities that can be done in a van or in an empty unit in the community center. How can we bring healthcare to the people instead of asking that low-income family that has no access to childcare to get across town into a medical facility where they can wait for hours and hours at the cost of their income?
Washington, D.C. and immediate transit-oriented suburbs.
Nice.
One city I'm very excited about right now is Detroit. I think there's a lot of talk about how downtown and midtown Detroit have come back, but there's not as much focus on sort of ensuring that newfound prosperity is shared among the neighborhoods. So I think there's a big opportunity to really sort of ensure that Detroit continues to grow in an equitable way.
For me, it's not any one city, but it's the secondary and tertiary cities in the heartland. It's Kansas City, it's Tulsa, it's Omaha, it's Des Moines. These places are being reinvigorated. The suburbs are retracting back in. They're doing a lot of interesting things in the first 18 feet of a community.
I think it's good to be unconventional in real estate. There's plenty of investment firms out there that are building in the markets where everyone is giving attention to, that are building sort of conventional product. I think if you want to make an impact, and if you also at the same time, often it ends up being a better investment decision is to go sort of in more unconventional places and to really sort of act more as a stakeholder as opposed to a one-off developer who's just doing one project.
Dan.
Find great partners. Find great partners that have interesting opportunities that are mission aligned, or even if they're not mission aligned, maybe they're adjacent. How can you both accomplish mutually beneficial goals? And the second thing is say no less often. So if there's an idea that you don't like or there's something that doesn't seem to work, flesh it out. Make sure you've exhausted all the options before you hit the no. Reduce the barriers to the yes.
Faraji.
So this this was told to me, I forget if it was Dave or Bill when I was here, but just remember that real estate is a derivative product of a different economy. So if you want your project to do well, you want to make sure that the neighborhood that project's in, the people in that neighborhood are doing well, and then that project is going to do well.
Thanks. Thank you guys for coming in. I had a question just on sort of investment horizon. I think there's been a lot of progress towards making development more feasible through tax credits, through government financing, et cetera. But I think once the project's developed, the cash flow can be, relatively small. And, as you guys are thinking about having fund lives, that are maybe not infinite. How do you guys think about sort of exiting an investment, and what kind of innovation does there need to be to make sort of the secondary market for these assets more accessible and more attractive to investors coming in, so that the flow of capital can be ongoing instead of just a one-time thing for development?
Faraji, why don't you take it?
Sure. We think about things for the most part on something like a 7-year horizon. We think that's a fairly reasonable cycle. Obviously that compresses or stretches out depending on a number of factors. To your point about being able to exit and where we can go. We're looking at a couple of blockchain companies who are pitching us on some really interesting stuff and making a lot of good promises. And if 30-40% of what they say is true, I think that's going to open up a bunch of new different markets and a bunch of new players who can come in and kind of take people in and take people out, kind of as needed.
I would just add, speaking of time horizons, I think a lot of people are focused on the Opportunity Zone program nowadays, and I think the program has a lot of areas that have attracted criticism, and I think it's right that there is a lot of sort of focus on refining the program. But at the same time, I think one of the benefits of the program is the required 10-year hold period, which really sort of encourages people to provide longer-term capital for communities. It doesn't totally address the question around secondary market, but it does mean that you have investors who are going to provide more patient capital when they're investing in new developments in areas targeted by the OZ program.
For me, so in the low-income housing world, it's a 15-year compliance period. The tax credits are recaptured anytime before the 15th year. So or it's essentially a 16 or 17-year hold period. So it's a year or two to build and lease up, plus 15 years. So that sort of handles that. The affordability period extends for another 15 years at minimum by regulation, and that land use restrictive agreement will carry with the land even through a transfer. So it must remain affordable 15 years beyond the initial 15-year compliance period. On the non-tax credit side, more workforce and affordable housing, that's not through the LIHTC program. There is a bit of a tug of war between maximizing financial returns for your current cohort of investors, but also keeping this in the affordable realm and ensuring that it lives on in an affordable doesn't lose its affordability at the end of your 7-year fund life. And so that's managing expectations up front, projecting it correctly, and the best time to talk about your exit strategy is before you even enter. And so you shouldn't have to figure this out in year 7.5 when you're trying to unwind this. Identify your sort of put options or your exit options and market those appropriately to your investors to ensure everybody goes in with their eyes open. Here's how we expect to exit this, and it might go back into the affordable realm. It might go back in for a tax credit allocation to remain in the affordable world.
Great, okay. I wanted to ask, I have a number of questions, but why don't I just ask the one that's top on my mind, which is about the sources of the capital and whether you're seeing new sources of capital like Quicken Loans getting involved in investing in Detroit. In DesignX, we have a lot of proposals for investment, sourcing capitals from within communities. Either people putting into a housing fund and then becoming owners of condos and units themselves, demonstrating that there's a lot more capital in what we call low-income communities than you would think, or in suburban communities by people putting up their homes as an investment in a larger development that may be on their property or several properties. I was wondering whether you see this as a trend or whether you have any experience with that. And that will help me in determining whether these are viable projects.
I mean, I can speak a little bit to that because that's a huge part of our model is, bringing in small local investors because we think that's who really cares about what happens to the people in those projects that they invest in. You are right, there's a huge appetite and there is more of an ability than I think people give a lot of these communities credit for. Logistically, it's a nightmare, so if you can solve for that, please let's talk after.
I would say it's also, in terms of sources of capital, I think there's often an opportunity when you're working with, mission-driven capital providers to structure, creatively to basically allow them to achieve, the most impact while still, ensuring that their capital is returned and able to generate more impact. So, we've seen creative structures where, if, for example, one of the projects we worked on in Detroit, there was significant sort of, soft equity, so to speak, from, various institutions that were interested in the area and interested in sort of seeing the long-term growth, such that if the project outperforms, they would be able to, participate in that and, generate a significant economic return. At the same time, as institutional capital often will not, take on the same level of risks just given where returns are in certain markets. So I think it's really about balancing that and finding creative ways to blend the two sources of capital.
Things that I've seen work well include first loss capital, whether that's from municipalities, states, foundations. Some big nonprofit foundations will do things like that. So they'll be the first in, last out dollars, and so they'll earn a higher rate of return, but they're the juniorist point of capital. They're also got to be the last out. So all the senior investors have to be paid out, made whole, or achieve their target IRRs before they get their dollars back. That then allows a more senior position or class of investor to come in, and it facilitates them looking at this in a more favorable light, like the institutional capital. Yeah, it reduces their risk. And it allows the first loss capital to absorb the first losses.
Hi, my name is Han Ho from Harvard Medical School. So in addition to practicing medicine, I do research on healthcare outcomes and housing. And so I have a question for Daniel, because you mentioned very interesting, I think at least two examples, Kaiser Permanente in California, and also I think another project, collaboration between like an emergency room and like a respite facility. As Alice mentioned, in real estate, it's important to make profit. I mean, in addition to doing other social good and things like that. I was wondering from the finance standpoint, whether if I were to separate the medical side and also the real estate side of the project, I was wondering whether both sides are sort of making a profit or at least have a balanced budget, or whether it's a situation it is sort of like one side kind of subsidize the other side.
Yeah,
based on the examples or other examples that you may have.
Sure. So I'll think back to the deal in Jacksonville, Florida, that is the respite on one half of the building and the low income on the other. The dollars don't move between the walls, so they don't. They're two separate partnerships. They bump into each other physically, but not economically. You can go as a resident of either side. You can go access the community benefits, the cafeteria, so on and so forth. On the low income housing tax credit side, the goal at the end of 15 years is to have a $0 capital account. So there's essentially no return of dollars in the low income housing tax credit world. All your benefits come in the form of tax credits. So that sort of handles the investor on the one side. On the respite side, I don't know the numbers off the top of my head, and if I did, I would have a wild guess, but the numbers to house, say, homeless, high frequency, high need care in emergency rooms to occupy those beds or move them down the hall in the hospital is astronomical. They've done the math, they've done the statistical analysis to say our dollars are better spent subsidizing respite care offsite and getting them there as opposed to, these are oftentimes non-payers. And so you think about the high cost of care, the $0 income, how can we better use, what tools do we have to better, more efficiently sort of, I don't mean to say offload these patients, but find a better way of managing their flow of care. And so allowing them this respite
But
units,
the care may be better as well.
the care might be better. And it offers them a better access to a wider pool of resources that's not just, needles and IVs. There are people on site that can help them with job training, with accessing resume work, with accessing, all sorts of different things that come with exiting a hospital after being a homeless person for X amount of days or years or months and having a different set of needs than your typical full pay low income housing resident. To answer that? So there's no cross subsidization. This deal had significant support from the state of Florida and soft loans that were contingent pay only from cash flow, which there probably won't be any. But considerable support from a lot of different angles, including hospitals themselves on the construction and the uses or the sources up front, and then an ongoing subsidy.
So I have a couple questions, but I'll start with something really simple. It just seems to me that capital is biased towards certain zip code and certain people that it wants to give money to, and certain places it wants to give money to. We're sitting here and we're talking about, let's talk about interest rates. If someone refinances a property that's on Fifth Avenue, they're able to get like a, 3 point something interest rate, some really great terms. But if they refinance a property in an impacted zip code, that interest rate could be 3, 4, 5 times more, right? And then the other example is whenever we put the word, impact capital or socially whatever capital, the interest rate goes up. So if I go to an insurance company and refinance my property, I can get a 3.75% interest rate. But if I go to like LISC, the interest rate is suddenly like, 7, 8, So I'm not really understanding why we don't simply offer the same terms to some of these impacted, zip codes and to some of these impacted people as we do. It just seems like they're keeping the capital. So it's like at the beginning we talked about 1% of the wealthiest people own 40% of the real estate, and 42% of the real estate is owned by the next 9%, and it leaves 18% to the rest of us, so 90%. And I thought, well, where do people of color fit there? So probably like 0.1%, right? And so, so a lot of things are going through my mind, and I'm sorry for not really kind of having thought it all through. But like I hear Kaiser Permanente's putting in 2-3% money, and I'm like, when did they make that available? Like, who do they make that available to? Why don't they make that available to community organizations doing these things? Because they never do, right? Community organizations have to go to impact funds that charge them 2, 3, 4 times more. So we just have to be realistic about what's really happening here. And so like in Detroit, for instance, I've been there and I've looked around and I saw 2 billionaires really lending each other money through their foundations, and they made a downtown for themselves. And then the rest of it, they don't care because they're not really invested in it yet. But when they do invest in it, there'll be some favorable terms available. So they're really just making sure that the stats that we got up front stays that way. So I think everything we do is to keep that stat the same, where, in terms of development, the people who are supposed to be developers, it's not the thinkers. If you're really a thinker and you want to be innovative in development and like move the needle another way, shift paradigm, you're going to get crushed by these terms, right? Or you're going to go work for one of these big firms where Kaiser Permanente is going to give you 2% money. But if you're a small firm that's really trying to move the needle, they're not going to give it to you. And so how do we change that? And I think the only way to do it is to leapfrog these institutions. And I think you said it, Faraji, like it's not going to be these big corporations that change this. It's not going to be the foundations. The foundations, they're really instruments of the big corporations to keep things this way. And so we're talking to the wrong people in terms of capital. because they're never going to give you capital if you think outside the box. And once you think inside the box, you just work for them. I don't think that was a question.
But does anyone want to comment on the panel? On what Ernst said?
Or anyone in the audience?
To Ernst's point, right? I mean, one of the big elephants in the room when we talk about impact, when we talk about, kind of social and all these other different things is, again, who are those communities, right? So those low-income communities are wildly disproportionately, people of color, Black people, Latinx people, kind of in this country. And there's no getting around that. And, if you do enough research, you start to get really, really kind of depressed because, you'll start to see that a lot of that is by design. And so in order to change that conversations and change that reality, like you really have to be very intentional about that. And that's very hard to do within a framework that just isn't really designed to, kind of change certain outcomes. Again, going back to this whole real estate as a derivative product, I mean, there's only so much you can do in a low-income community if you don't change their incomes. Like that's the bad word there is low income, because you don't want those incomes to be low, right? You don't want to make poverty just a little bit more tenable. You want to make poverty start to disappear and go away and people not be so poor. And again, doing the same thing gets you the same results. So I think we do have to be a little more creative and a little more interesting in how we think about solutions to these problems.
Yeah, I would just add to that. I mean, I think that this goes back to my sort of original point around the public sector, because I agree that when you look at who is actually driving change and driving decisions, how much can a developer really change, right? At the end of the day, a developer is going to develop where they can get capital and where they think they can make a return. I think on the margins, if you have impact-focused developers, maybe they'll take a little bit lower return. And I think the same goes for impact capital. If you have impact capital, maybe you'll take a little bit of lower return, but is it really sea change? I think for that, you really often, I mean, politics is the driving force behind a lot of this, right? I mean, if you really want to have the policies that support that and the regulations and incentives that encourage development different from what we have today, you really have to look to the public sector. I think I agree that you're not going to sort of see sea change without sort of the public sector spearheading it.
Thankfully, we have a public sector panel coming up after this.
Yeah, a little bit picking up from the previous question. I wonder to what extent more and better data and analytical tools could help to address some of these issues. It seems to me that actually a lot of the ESG investments should be lower risk than non-ESG investments, right? They have kind of guaranteed markets, and returns should correspond to risk. If they're lower risk, they should have lower cost of capital. And but clearly, I mean, there's a lot of sort of herd behavior and prejudice in capital flow. But I think that better quantification, more and more solid data and analysis might be able to dispel some of the sort of perceptions that a lot of the capital is flowing based on. So I'm wondering if you guys have any take on that. Is there much, because you can't really talk about returns without talking about risk, the corresponding risk, right? Return by itself is kind of meaningless. And so if we could quantify the risk, I bet you we would see that in a lot of cases, the risk of these projects is lower than the risk of some, glossy high-rise that's market rate. And at first people aren't even going to believe that, but if you could quantify it, credibly enough, over time it might help to draw more capital. But I'm not very familiar with already what sort of data is available to quantify the risk side of these projects.
I can take a first stab. I mean, I agree with that. I mean, I think two concrete examples that come to mind. One is affordable housing. Affordable housing, if someone tries to tell you that they should make a higher return on an affordable housing deal than a market rate housing deal, I personally think that's crazy, because affordable housing is inherently less risky because you're below market. And I think that is, an educational process that a lot of times, people have perceptions about it, but in reality, the return profile should be lower for affordable housing. I think the other example that comes to mind, before I talked a little bit about the loan facility we closed that was supporting, basically a student loan facility to support vocational training programs. I mean, if you look at the way that student loans are underwritten, there is just, a blatant, people are basically being, judged based on their current credit scores when there's tons of data out there about how access to education can improve people's credit scores and improve ability to repay debt. So, I think there are a lot of opportunities out there that are, to that point, just not being recognized by the market, even though the impact does allow it to generate, a stronger risk-adjusted return.
Yeah, so we have tons and tons and tons of data that says that women-led companies and companies with lots of women on their boards outperform male-dominated companies. But then you look at kind of the C-suite at Fortune 500 companies all throughout. So you can have all the data you want that kind of you still have to change kind of the behavior and the inherent kind of bias and belief system of people, and that's a road to hoe, man.
Sure, I wanted to build on that question, which is obviously getting right to the heart of everything, and the thread that both of Faraji and Alan talked on. This is the beyond the built environment, the derivative comment you made. So much of doing the leapfrog that needs to happen and remake some of these communities involves them owning the benefits. And we've talked a lot about maybe lower BIPs and lower return, but do you see any of the capital or any of your mission focused on who winds up with this at the end of the day and really having it be the community? That seems to me the answer to this, but we're kind of siloed in the built environment. And further to that, to have the income to own it and the opportunity to kind of remake it, you do need beyond the built environment. You need investment and accelerators and angels and everything for all these entrepreneurs in those communities to make their communities there. So that other capital that you talked about, are you able to cross silos and find that capital that will invest in the actual businesses there as well as the built environment?
So I can talk a little bit about some of the challenges around, real estate as an asset class is really tough for poor people to own, right? If all I have is $1,000 and I invest that in the stock market, it could go down to zero, but it doesn't need a new roof, kind of its tenant isn't going to be 2 months behind on rent, or kind of I'm not going to get a water lien on it. But we still have to try. One of the projects that we're piloting is this kind of granny's house, and we haven't come up with a name for it yet, but we know that a lot of real estate wealth is lost as kind of older members of the community don't have kind of children or don't have heirs or next of kind of succession to take over their homes, and so those homes typically, as they fall into disrepair, are sold to developers for typically kind of very low dollar, who then convert these, and then that kind of spirals this gentrification kind of vortex. So what we're trying to do, and we're working through a couple of projects right now, is for those homeowners who can do it, and this is, if you say take 100 homeowners, now you're moving it down to 50, but who have the financial wherewithal to actually participate in the deal, we're trying to get them into those deals. So we can give you more money because we're going to pay you less money up front, but we're going to give you higher returns kind of out of the back end and treat you just like, kind of a normal LP. And so instead of paying, kind of a bank X percent and, an equity investor X percent, you, the homeowner, can now collect that value. Now, it's great to do, kind of here and there and over here maybe, but, like when Blackstone is buying up, kind of thousands of houses, kind of at a clip at, kind of the Wayne County auction or wherever it is, it's the scale issue, right? So I think we have an idea. I think it's just, can we scale it, right?
I think maybe part of the question was how do we keep the benefit in the community and not have it fly off to New York or LA or the economic benefit. Places like DC have TOPA where the tenants have the option to purchase their communities. I believe that's everywhere in DC. and I don't know the whole ins and outs of it, but that's an interesting legislative tool to allow low-income communities to retain and have the option to purchase the asset in which they live. And it's sort of a community benefit. Those dollars stay right there. Different organizations, Enterprise included, has worked with TOPA organizations in DC with non-LIHTC, non-tax credit dollars, and our low-cost conventional equity on our loan fund to collaborate to give them the financing needed to do that, as well as the technical assistance. So there's different ways of doing that, but again, it's a legislative tool. It's a very difficult thing to enact. There will be lots of objections from who knows where, but that's an interesting sort of thing you could think about or do some exploration around.
I can speak a little bit to TOPA as a DC
Yeah,
native, and TOPA is idea-wise a great idea. It is massively ineffective. I mean, if you look at the amount of residents who are covered by TOPA, and then the actual dollar transacted volume of real estate to those, I mean, it is, I don't know, maybe a percentage of of the overall kind of for sale. I mean, it doesn't do shit, frankly. Excuse my French.
Yeah, I would add, I think that one potential solution is to really focus on areas that currently have a lot of home ownership, because if people have lived in a neighborhood where home prices have been low for a long time, and suddenly there's a whole wave of gentrification, obviously the outcome looks very different if people have been renters versus homeowners. And I think when you can really cultivate home ownership in an area like that, people should meaningfully partake in, their investment. I mean, if people, have lived in an area for decades and suddenly there's, huge investor interest, I mean, they should be, that should be a wealth creation event. And I think home ownership is a way to accomplish that, and focusing on areas that currently have strong home ownership.
Or they should be able to participate in the increase in value that's being created on their properties, rather than just selling and letting someone else take the profit of the development.
I think we have time for one more question on the floor.
I didn't have a question, but I had a comment.
We'll take the comment.
Hi, my name is Mert Karakush. I had a question related to what we just discussed about capturing the positive benefits of home increases. So one thing that we learned from some of the community organizations that we are working with in places like Chicago is that when gentrification happens, one immediate consequence of that is property taxes going up at the local level. And especially with lower income communities, then this becomes a challenge of, being able to afford living in the home that you own. I was wondering whether, local policies such as property taxes come into your calculations, and how you are dealing with challenges related to that.
Yeah, so I mean that's a huge problem in DC. And DC actually, I will give DC government credit. They have a number of different programs especially for elderly homeowners, kind of under a certain income threshold, where they freeze or kind of lower those taxes. And I think that can be helpful, but again, you're talking about typically, a couple $1,000s difference a year, and so there's some level to which it's kind of a marginal, kind of part of the overall financial pressure on people. I mean, one of the other things that happens when the neighborhood gentrifies is that services get more expensive, right? It's like the food gets more expensive, and the place you used to go cut your hair, just all these different things that you used to have access to at a relatively affordable, kind of price point, now all of a sudden go up, and especially as the retail rents, kind of really start to increase, it becomes very difficult for people on limited incomes to just buy the neighborhood, and so you have that soft gentrification where someone isn't forced out or evicted out of their house, but just at a certain point just throws their hands up and so to speak.
So we'll take your comment, Dennis, and then close off.
Okay, well, one of the, this ties into something I was talking about before, but also the conversation. I think one of the things we need to look for
are new sources of capital, and they are coming into the market. I mean, the hospitals investing in housing is a fantastic example of that as a way to deal with the other huge increase in costs, which is healthcare, okay? And to make communities healthier in both the short and long term saves a lot of money. So that can be used as a source of capital for housing. We have universities investing now in real estate development like gangbusters, and universities are the largest employers in 77% of the cities in the US. So there's another opportunity for leveraging investment towards social goals as well as returns. Tech companies. What I'm looking at are sources of capital that aren't totally driven by the returns investing in square footage, that capital is coming from other sources. People will always want returns, but if 100%, like a traditional bank, sorry, JP Morgan or other places, all of their money comes from the investment. But if the capital is coming from another source in the business, then I think you have a greater opportunity for some creative financing for housing. And I'm actually cheered by more and more and more and more unconventional sources getting into community investment and providing sources of capital. And eventually, I think the scale, I'm always optimistic, will tip. Okay, and that the banks and traditional investors will begin to realize that maybe the prejudices that they had about returns from these communities were wrong.